With almost 90% of companies reporting earnings that have beat estimates, and with markets at all-time highs, have we reached peak growth? Well, listen to portfolio manager Charlie Toole and me as we explain the second quarter earnings, what it means for the market, and what it may mean for the quarters ahead.
Hello, and welcome to another Advisor You Can Talk To podcast. I'm Charlie Toole, and I'm joined today by Steve Johnson. Steve, how are you doing today?
I'm great, Charlie. Thanks for having me.
Thank you for being here. And we are the co-managers of the Dividend Income Strategy, and we're here again to talk earnings. Our team's been busy over the past few weeks reading earnings releases and listening to management teams on earnings conference calls. And in this podcast, we'll talk about the major themes that we've been reading and hearing about. So let's jump right in. Steve, some numbers to start with. Nearly 90% of the S&P 500 have reported earnings for the second quarter so far. And according to FactSet, earnings are nearly 90% higher than they were at this time last year. And only Q4 of 2009, going back to 2008, has a higher quarterly growth rate or year-over-year growth rate at 109%. So it's a bit of a loaded question, but is this as good as it gets for earnings growth?
You know, Charlie, we could have said the same thing last quarter. But remember, during the second quarter of 2020, earnings were dismal because of the pandemic. So this year made easy comparisons. Plus, you have to give the economy credit, it has recovered strongly. So companies have been able to report better than expected earnings. In fact, Charlie, you're talking about beating earnings. The average company has beat those earnings by 17%. So again, just goes back to see how accurate the analysts really haven't been. But again, there is strength in the economy. We're coming off of very easy comparisons, and so companies have been able to be very successful in recording these earnings.
Good, and that's a good point going back to last year, because I think the companies that we're seeing that are leading the charge have been the companies that were hit hardest last year, whether it's casino companies and leisure companies, energy companies, and consumer discretionary companies. So think, retail. These are the areas that we're seeing the biggest beats and the best revenue growth.
Yeah, you're exactly right. I mean, it's to be expected, right? So if you're Las Vegas Sands or Wynn Resorts, clearly your business shut down last year, during the pandemic, and so you've been able to record enormous growth year over year as you've reopened. The other theme, Charlie, is we've been talking about this. I think it seems like a broken record, but we've just also seen enormous revenue and sales growth from the large tech companies, right? So you've seen the largest percent increases from the likes of Wynn and Las Vegas Sands, but we've seen the greatest dollar increases from large tech, large cap tech. So Amazon, Apple, Microsoft, just again showing incredible growth year over year, and again that's been a theme that's been consistent now for the last couple of years.
Right. And what makes the growth of those three tech companies in particular impressive is that unlike other companies that struggled a year ago, those tech companies were actually thriving in the work from home, stay at home environment. So that makes their growth rates all the more impressive. Shifting gears a little bit, I do want to talk about profit margins. And so, we've talked about revenue and earnings being higher than they were a year ago, but companies are also raising profit margins or having higher profit margins. And so we're tracking at about a 13% profit margin, which again would be an all-time high from FactSet going back to 2008. And really the dynamic that we're seeing here is there's a lot of costs related to COVID that are falling as we start to reopen and see vaccinations take hold.
Exactly right. I think this has been the biggest surprise for analysts, as well as kind of as people are trying to predict where stock prices would go. Everyone believed that margins would be compressed, right? As we thought about this, what's the word we've heard for the last 6 months? Inflation, right? And on all of these conference calls, we've heard whether it be Pepsi which talked about kind of the impact to their earnings next year because of freight costs and because of input costs. We've heard it from Kimberly Clark and Procter and Gamble. But despite the issues with input costs, companies outside of consumer staples, such as technology, industrials, and energy, have seen their margins increase. So when we look at technology companies, you look at industrials, you look at energy, all of those sectors have benefited, to your point, about kind of COVID costs coming down. They've had a lot of leverage coming in to this. And as well, if you think about it, the U.S. consumer has had a lot of stimulus. And so while they've been at home, their incomes have actually gone up. And so it's allowed them to really pay higher prices. So companies have been able to pass those costs along. So I guess to your earlier question, though, is this as good as it gets? Well, we'll see. But it does seem that these profit margins, it would seem hard for them to remain elevated at this level.
Right. And we mentioned the drop in COVID costs, but there are other costs that have started to come back, like marketing spending, and some costs that have yet to come back, like business travel. You're not seeing business travel get back to areas or to levels that were pre-pandemic, and it's probably not likely. And that I pivots, I think, to our next point is really the one area that hasn't come all the way back, and that's travel. I mentioned business travel not picking up. Visa and MasterCard, they track what's called cross-border transactions, and those are transactions in different countries from where you're domiciled. So those are basically think people making transactions when they travel, and those cross-border transactions are only at 50% of what they were pre-pandemic. So you're not seeing, I think, again, because whether it's the Delta variant or vaccination levels in internationally aren't as high as they are in the US, you're not seeing that international travel pick back up where you are seeing it on the domestic side.
Yeah, exactly. And Charlie, we haven't even talked about the Delta variant. So, these companies reported during the second quarter, we were kind of, everything was reopening. Everyone was going back out to eat. They were traveling. They haven't seen people in a year or two. Now, all of a sudden, as we've seen over the last month, and we as you know, we track things like open table and kind of reservations, and as you mentioned, the spending numbers, and we've seen kind of them plateau and actually slow down. And so the question is for the third quarter anyway is, yes, we have seen travel increase, but with this Delta variant, will we start to see, people, be a little bit reluctant to go back out again? And so, will we start to see dining slow down? Will we start to see that spending slow down from that peak that we saw perhaps in the second quarter?
All right, Steve, I'm glad you brought up the Delta variant because a lot of the data that we're talking about today was reported and commented on by management teams before the Delta variant really took off in the United States. And I think we saw management teams guide conservatively. Of the 450 or so companies in the S&P 500 that reported earnings, only 71 issued guidance for the next quarter. So management teams were very conservative in even forecasting what might happen in the next 3 months. Maybe they foresaw the Delta variant, or maybe they foresaw something else. But we saw management teams steer or err on the side of caution.
Yeah, it's a great point, Charlie, because if you look at, yes, 60% of the companies issued positive guidance, yet there's still quite a few, 29 out of those 71, that issued negative guidance. And as you mentioned, there are a variety of factors, and it goes back to your earlier point about, is this peak earnings? So you've seen the inflation pressures that people have seen throughout the quarter. We've also talked about perhaps wage increases. We've talked about an increase in the minimum wage. We've also, we've really talked about perhaps the economy, maybe reaching its peak here. And so companies, this is as good as it gets for them. And so a lot of these companies are, to your point, a little bit hesitant. As we've talked about Pepsi, for example, they said earnings may be impacted up to 70 cents next year by all of these different costs. And so perhaps they're hedging, perhaps they're sandbagging for next year, but clearly they are setting the bar a little bit lower because of all of these, really, these unanticipated factors that we're witnessing.
Right. And costs get into sort of the last topic that I wanted to bring up. And this was a topic that we talked about last quarter, and we'll probably talk about it again next quarter. It's really the dynamics of inflation, supply chain disruptions, and specifically semiconductor or chip shortages. And I think you had already mentioned consumer staples companies like Pepsi, Procter and Gamble, Kimberly Clark, talking about price increases, high labor turnover, or just struggling to find workers is something that companies like McDonald's have mentioned. And then chip shortages have impacted companies from Apple to Intel and even some industrial companies. So this is something that we've talked about a lot, inflation being transitory or these supply chain disruptions being transitory, but it is still having a material impact on a lot of the earnings of these companies.
Yeah, and I can't imagine being a CEO right now because it is so hard to predict. I think their business going out 6 months in normal times, and now you have all of these factors, whether it be the supply chain issues, kind of wages now and labor shortages that they're having to deal with. But I will say, what we have seen recently is that a lot of the fear of inflation, we're starting to see some of those prices come down. We've seen lumber down almost 70% from its high, iron ore down 30%, oil's down 15% from the high. And so there is a sense, I believe, that perhaps we are seeing the peak readings in inflationary pressure that may make it easier for some of these companies as they go forward. The other part of that is, a lot of these companies have been able to pass on these price increases. We
Mm-hmm.
were listening to Procter and Gamble's call, when they were talking about some of their leading cleaning products, the Swiffer, for example. They're implementing a double-digit price increase beginning in September. And as you know, once you pass those along, pretty hard if you're the CEO to bring them back. And so
Right.
the question is, though, and in my mind is, for now, consumers have paid these higher prices because they're flush with stimulus and they've had, you know, incomes have gone up. The question is, in September, we know that those stimulus checks are going to be ending. And so now we're going to go back to perhaps a more normal recovery, more normal economy. Will consumers be willing to pay up for those goods, for those higher quality goods that are a little bit more expensive? And I guess if they're not, and companies start seeing their sales decline in the fourth quarter and the first quarter, what will that do to earnings? And so I think that's a variable that we don't know yet, in whether or not the consumer stays strong. But that will go a long way of determining what those earnings will be and whether or not these companies will be able to maintain these higher prices.
Steve, I think that's a great spot to end it. So thank you for joining me today. And I think the big takeaway from our conversation is that corporate profits are still growing, but growth rates in the second quarter are probably going to peak and continue to decline, although still remain positive. And we'll continue to keep an eye on supply chain constraints and how this impacts corporate profits and inflation. So this has been Charlie Toole and Steve Johnson from Advisor Investments, thanking you for listening to the Advisor You Can Talk To podcast. If you enjoyed this conversation, please subscribe and review our show. You can check us out at advisorinvestments.com/podcasts. Your feedback is always welcome. If you have any questions or topics that you'd like us to explore, please email us at info@advisorinvestments.com. And before closing, I'd like to thank Ashlyn Melvin. She makes this podcast happen by doing all the complicated technology that Steve and I have no clue how to work. So thank you, Ashlyn, and thank you for listening.